Imagine opening your brokerage app, right? You grab your morning coffee, you're scrolling through, and you see this sleepy, this 100-year-old regulated water utility posting a nearly 17% revenue jump in a single quarter.
It completely breaks your brain for a second.
Right. Because my first thought is probably something along the lines of, did the entire state of California just start taking 17% longer showers?
Which is biologically impossible.
Yeah, exactly. Or, maybe you think there's a glitch in the app. Because normally when you see a top-line growth number pushing up toward 20%, you are looking at a Silicon Valley software as a service company.
Right. A hyper-growth tech darling.
Yeah, or maybe some biotech firm that just got a surprise FDA approval. You are not generally looking at the company responsible for, maintaining the cast iron pipes buried under the streets of Bakersfield. But that is exactly what happened here.
And it creates this immediate cognitive dissonance for anyone who actually follows the markets. You have a sector that is traditionally viewed as the ultimate bond proxy.
Slow, steady, totally unexciting.
Exactly. It's the kind of stock you buy for your grandmother so she can collect a modest dividend, right?
Yeah.
And suddenly it's throwing off these growth numbers that look wildly out of character.
Yeah.
And the danger here, the real danger for the retail investor listening to this, is taking that headline number at face value without understanding the incredibly dense, highly regulated machinery operating just beneath the surface.
Which brings us to our mission today. We are jumping into a very special Talk Tickers edition of our deep dive.
Oh, yeah.
If you are a retail investor trying to navigate the modern stock market, you already know how heavily the deck is stacked against you. Institutional investors, these massive hedge funds and mutual funds, they have literal armies of analysts whose sole job is to translate Wall Street jargon.
Entire floors of people just crunching regulatory filings.
Right. So when a company drops an earnings report filled with terms like decoupling mechanisms or regulatory balancing accounts or adjusted EBITDA, those institutional armies, they know exactly how to price it instantly.
While the retail investor is usually just left reading some sterilized press release.
Yeah, feeling like they need a PhD in corporate finance and a law degree just to figure out if the underlying business is actually healthy or if it's all just smoke and mirrors.
The information asymmetry is staggering. It really is. It pushes the average person into making these split-second portfolio decisions based on incomplete or just fundamentally misunderstood data. They buy on a fake breakout or they panic sell on a misunderstood regulatory delay.
Well, we are here to dismantle that asymmetry today. The Talk Ticker's mandate for this deep dive is ruthless and simple. We are cutting through the noise.
Cutting right through it.
We are going to be heavily data forward. We are translating every single piece of corporate jargon into plain, actionable English. And we are going to be highly opinionated about management's performance.
As we always are.
Exactly. And we are going to conclude with concrete advice for you, the stockholder. When you finish listening today, you will know exactly what is happening inside the engine room of the company we are dissecting.
And our target today is a literal masterclass in why you can never, ever judge a stock purely by its sector label. We are analyzing California Water Service Group. The ticker symbol is CWT.
CWT.
Right. And specifically, we are ripping apart the transcript of their Q2 2026 earnings call, which took place on July 30th, 2026. This call was led by their CEO, Merton A. Kropelnicki, and their CFO, James Patrick Lynch.
At first glance, a water utility sounds like the absolute cure for insomnia. You turn on the tap, water comes out, you pay your monthly bill, end of story.
It's the illusion, yeah.
But let me tell you, reading through this specific transcript, it reads less like a sleepy infrastructure update and significantly more like, a high-stakes thriller involving aggressive environmental litigation, complex macroeconomic maneuvering, and billion-dollar regulatory chess games.
It's intense once you get into the hood.
It really is. So let's get right to the data. I want to start by tearing into the raw numbers that hit the news wires because they paint a picture that absolutely demands an explanation.
The headline numbers for the second quarter are what shocked the algorithmic trading bots, honestly. And they provide the baseline for everything else we're going to discuss today.
Okay, so I'm looking at the income statement, and the top line looks almost like a typo for a utility. Total revenue for Q2 2026 came in at a massive $309 million.
Huge.
That is a 16.6% increase from the $265 million they reported in the second quarter of 2025. That's a $44 million leap in quarterly revenue.
Just in one quarter.
Yeah. And year to date, their revenue is sitting at $523 million. Then you move down to the bottom line earnings per share, or EPS. They delivered 93 cents per diluted share.
which is a massive jump.
A massive jump from the 71 cents per share they reported in the prior year period. Year-to-date EPS is $1 flat, up from 93 cents. And just to put a bow on it for all the income investors out there, they declared their 326th consecutive quarterly dividend at 33.5 cents per share.
Let's actually pause on that dividend stat for a second, because scale matters here. 326 consecutive quarters. That is over 81 years of uninterrupted dividend payments.
Wait, 81 years?
81 years. That means they were paying this dividend during World War II, during the dot-com bust, during the 2008 financial crisis, and straight through a global pandemic.
That was wild.
And that current payout, it represents a 5-year compound annual growth rate, a SEC-share of 7.6%.
Okay, so the dividend pedigree is undeniable, but I have to play the skeptic here on the top line. I absolutely refuse to believe a regulated water utility grew its actual organic business by 16.6% in 90 days.
Right, because we established that people didn't suddenly start consuming vastly more water.
Right, so if a software company posts a 17% revenue jump, it usually means they acquired a massive chunk of new users, or they successfully forced a price hike on their existing user base. But CWT didn't acquire 1 million new households in 3 months, and they didn't just arbitrarily hike prices overnight, so where does a $44 million revenue jump materialize from?
It materializes from the bureaucratic reality of the regulatory calendar. And this is the fundamental difference between analyzing a tech stock and analyzing a utility stock.
Okay, break that down.
With a tech company, you are modeling consumer behavior. With a utility, you are modeling legal proceedings. This massive revenue beat isn't about consumer volume spikes at all. It's entirely about regulatory timing and accounting catch-ups.
So you are saying this growth is essentially a mirage?
I wouldn't call it a mirage because the cash flow is very real, right? The earnings go straight to the shareholder equity. But it is an anomaly in terms of timing. It's a manufactured spike based on when the referee, in this case, the state regulator, finally blew the whistle and authorized the new rule book.
I see.
Yeah, so to really understand how they built that 93-cent EPS, we had to decode the specific components that the CFO laid out on the call.
Let's do it, because CFO James Patrick Lynch, he didn't hide the ball here. He itemized the beat for the analysts on the call. According to the transcript, he attributed a positive 20-cent impact from customer rate changes, a positive 15-cent impact from something called the IRMA, and a positive 11-cent impact from deferred RAM revenue.
RAM, yeah.
These acronyms are exactly the kind of jargon that causes a retail investor's eyes to just completely glaze over. Let's tackle IRMA first. The transcript notes it stands for Interim Rates Memorandum Account. I mean, that definition is just as confusing as the acronym itself.
It's a perfect example of regulatory obfuscation, honestly. To understand an IRMA, we first have to take a step back and look at the engine that drives every single utility's revenue, which is the GRC, or general rate case.
The massive multi-year legal trial where they basically just beg the state for money?
That is a cynical but essentially accurate way to describe it. Every few years, a utility has to compile literally thousands of pages of documents and go before the state's Public Utilities Commission. They say, look, here is a detailed blueprint of how much capital we plan to spend on replacing water mains, upgrading treatment plants, and paying our workforce over the next 3 years.
Right.
And based on those required costs, here is how much we mathematically need to raise our customers' water bills in order to earn our state-mandated profit.
And the state commission audits this. Consumer advocacy groups fight it, politicians grandstand about it, and eventually the commission issues a final decision authorizing a new set of rates.
Correct. Now, CWT filed their 2024 California general rate case with the full expectation that the newly authorized higher rates would officially kick in on January 1st, 2026.
But government agencies are not exactly famous for hitting their deadlines.
They're definitely not. The final decision was delayed. It was supposed to be implemented on January 1st, but CWT didn't get the final green light from the commission until the end of April.
Oh, wow. Okay, so that creates a massive problem for the company then, because for January, February, March, and most of April, a delay of roughly 90 to 100 days, CWT is out there spending money based on their 2026 budgets, but they're still legally forced to charge their customers the old lower rates from the previous 2023 cycle.
Exactly.
They're essentially undercollecting millions of dollars every single week through no fault of their own.
Which is where the IRMA comes to the rescue. The Interim Rates Memorandum Account is, in plain English, a regulatory IOU.
An IOU. Okay.
The State Commission knows they are late, so they tell the utility, keep charging the old lower rates for now. But open up a tracking account, the IRMA. Keep a meticulous ledger of the exact difference between the old rates you are currently charging and the new higher rates that we will eventually approve.
Okay, I'm tracking.
And once we finally issue our decision, you are authorized to retroactively apply those new rates all the way back to January 1st, and you can collect all that back pay.
This is starting to click. I want to test an analogy here to make sure this makes total sense for the listener. Let's step away from water pipes for a second. Imagine I own a large apartment building. I'm a corporate landlord.
Okay, a landlord.
I send a notice to my tenant saying, hey, your lease is renewing on January 1st, and your rent is increasing from $1,000 a month to $1,200 a month. But my city has a strict rent control board, and they step in and say, hold on, we need to review and authorize this 20% increase, and the review process is going to take a few months.
That maps perfectly to the general rate case delay. So what happens in the first quarter?
In the first quarter, my tenant keeps paying me $1,000 a month for January, February, and March. I'm feeling a cash crunch because my property taxes and maintenance costs went up on January 1st, but my revenue is completely frozen.
Right.
Then, in mid-April, the rent board finally bangs the gavel. They announce, okay, the $1,200 increase is officially approved, and we are making it retroactive to January 1st.
And how does that impact your April revenue?
Well, it explodes because suddenly my tenant doesn't just owe me the $1,200 for the month of April. They owe me the extra $200 they shorted me in January, the extra $200 from February, and the extra $200 from March. So in April, they have to hand me a check for $1,800.
Now, view that through the lens of a quarterly earnings report. If you are a publicly traded landlord, you would report $1,800 in revenue for that specific period instead of your baseline $1,000.
Oh, wow.
Right? An algorithmic trading bot or a retail investor who only reads the headline would look at your Q2 report and say, incredible, this guy's rental revenue grew by 80%. But the reality is your core business didn't grow 80%. You just finally collected the back rent. It's just a catch-up mechanism.
And that is precisely what materialized in CWT's second quarter. In Q2, they recognized a sudden $15.3 million influx of IRMA revenue. That is the retroactive application of the new California rates back to January 1st. That single delayed chunk of money drove 15 cents of their 93-cent earnings per share beat. It wasn't organic hypergrowth. It was literally just the state finally allowing them to cash the IOU.
Which is the core lesson of the Talk Tickers philosophy.
Yeah.
I mean, if you bought CWT stock on the morning of July 31st, simply because you saw a 16.6% top-line revenue jump and assumed management had unlocked some miraculous new revenue stream,
you'd be totally wrong.
You would be buying based on a fundamental misunderstanding of the asset. You have to normalize that revenue. You have to smooth out that $15.3 million bump over the entire year to understand the true sustainable run rate of the business.
Okay, that successfully demystifies the IRMA. But the CFO also cited a positive 11-cent EPS impact from something called deferred RAM revenue, RAM. He noted they recognized $9.3 million in remaining deferred RAM revenue, though he did caution that it came with $7.9 million in associated expenses.
Right.
So the net profit impact was smaller than the IRMA, but it still artificially pumped up the gross revenue number. What is a RAM, and why on earth was it deferred?
RAM stands for Revenue Adjustment Mechanism. And to unpack this, we need to take a deep dive into one of the most critical yet least understood concepts in modern utility regulation, which is decoupling.
Decoupling. I see the word decoupling in almost every single utility 10K filing I read. It sounds like a legal term for a corporate divorce.
In a practical sense, it actually is a divorce. It is the severing of the relationship between two metrics that used to be permanently tethered together: the volume of a product sold and the revenue generated from selling it.
Wait, I need to push back on that because that violates the most basic law of capitalism. If I run a lemonade stand, my revenue is inextricably linked to volume. If I sell 10 cups, I make $10. If I sell 100 cups, I make $100.
Historically, didn't a water utility operate the exact same way?
Historically, yes, they did. The more water they pumped through the meters, the more money they made. Volume equaled revenue. It makes perfect financial sense in a vacuum.
So why change it? Because while it makes perfect financial sense, it creates a catastrophic environmental and social policy failure. Think about the perverse incentives it creates.
Okay.
If a water utility only hits its profit targets by maximizing the volume of water sold, they have zero financial incentive to encourage their customers to conserve. In fact, their fiduciary duty to their shareholders means they are quietly hoping for blistering, arid droughts so that every homeowner in their district runs their lawn sprinklers for 3 hours a day.
Oh, wow. I see the conflict now. You have states like California facing historic multi-year droughts. The state government is begging citizens to take shorter showers, install low-flow toilets, let their lawns turn brown. But the utility company is sitting there knowing that if the citizens actually listen to the government and conserve water, the utilities revenue will completely collapse, and they won't be able to afford the maintenance on the pipelines.
Exactly. The state's environmental goals and the utility's financial survival were totally misaligned. The utility was essentially being penalized for successful conservation. So regulators stepped in and invented decoupling. They decoupled the utility's authorized revenue from the actual physical volume of water sold.
Walk me through the mechanics of how that actually functions in the real world, because it sounds a bit like magic.
It works like this. During that massive general rate case we talked about, the state conducts a forensic audit of the utility. They determine exactly how much revenue the utility requires to cover all its fixed operating costs, maintaining the reservoirs, running the chemical treatment plants, paying the pension obligations, plus a fair predetermined profit margin for the shareholders.
Okay.
Let's say, just for simplicity's sake, that target number is $100 million for the year.
Okay, the state guarantees them $100 million in revenue.
The state then sets the per-gallon water rates based on a complex forecast of how much water they predict the population will use, mathematically aiming to hit that exact $100 million target.
Yeah.
But forecasts are never perfect, right?
Right.
What happens if California experiences an unseasonably wet spring? It rains for 3 months straight, nobody turns on their irrigation systems, citizens aggressively conserve, and at the end of the year, the utility has only collected $90 million in revenue.
Well, under the old lemonade stand system, the utility just eats a devastating $10 million loss, their stock plummets, and they likely have to defer critical infrastructure maintenance.
Precisely. But under decoupling, the state honors the guarantee. The state says, you were authorized to collect $100 million. Through no fault of your own, due to weather and excellent conservation, you fell short. Therefore, we will allow you to add a temporary surcharge to your customers' future water bills to claw back that missing $10 million.
Wait, they literally cannot lose on the volume side. It is a completely insulated business model.
It is a two-way street, though. What if it's a record-breaking heat wave, everyone is watering their lawns, and the utility ends up collecting $110 million?
Ah, okay.
Under decoupling, they do not get to report a surprise $10 million windfall to their shareholders. They are legally required to refund that excess $10 million back to the customers in the form of lower future rates. The ledger that tracks this constant over and under collection is the RAM, the revenue adjustment mechanism.
That makes perfect sense. So looking at Q2, CWT recognized $9.3 million in deferred RAM revenue. This was essentially old money, historical balances from past decoupling variations that were sort of trapped in an accounting limbo until the state commission provided the final regulatory guidance on how and when to recognize it on the income statement.
Right, exactly.
It's just another one-time catch-up bump to the quarter that makes the headline growth look far more aggressive than the underlying reality.
Yes, that effectively closes the book on the historical quirks of Q2. But here is where we must look forward, because the transcript revealed a massive structural shift for CWT's future. In this newly settled 2024 California general rate case, CWT did not get full traditional decoupling renewed.
Hold on. If traditional decoupling was the safety net that guaranteed their revenue regardless of drought or conservation and they lost it, that sounds incredibly bearish.
It does sound bad at first.
Doesn't that re-expose them to all the volume risk we just discussed? If it rains all next year, are they going to take massive losses again?
It would be a catastrophic bear case, except management successfully negotiated a replacement mechanism that is arguably more efficient for both the company and the consumer. It's called a sales adjustment mechanism, or SAM.
SAM. Okay. If the RAM tracks the revenue, what does the SAM actually do differently? Because from a retail investor's perspective, they sound identical.
The difference lies in how the debt is carried and settled.
Yeah.
Under the old RAM system, if the utility undercollected by $10 million in year one, that $10 million deficit would just sit in an account on the balance sheet. In year two, if they undercollected by another $10 million, the balance grows to $20 million. It would just sit there, compounding until the next general rate case 3 years later.
And then what? The state just allows them to hit the consumer with a massive multi-year bill all at once.
Exactly. And that creates fierce political friction. Imagine being a consumer who has been aggressively conserving water for 3 years, and suddenly your bill spikes by 15% because you were being hit with a surcharge to pay for water the utility failed to sell 3 years ago.
I would be furious.
It enrages the public, and it makes politicians very nervous.
So how does the sales adjustment mechanism solve that friction?
The SAM fixes the problem in real time. Instead of letting a massive dollar deficit build up on a ledger, the SAM allows CWT to adjust their actual sales forecasts annually.
Oh, annually.
Yeah. If CWT projects they will sell 100 billion gallons of water in 2024, but a wet winter causes them to only sell 90 billion gallons, they don't rack up a massive IOU. Instead, they go to the regulator and say, look, our baseline forecast is clearly wrong. For 2025, we're utilizing the SAM to reset our forecasted volume down to 90 billion gallons, and we will adjust the per gallon rate accordingly right now to ensure we hit our authorized revenue target.
Oh, that is brilliant. Instead of carrying a massive politically toxic IOU on the balance sheet for 3 years, they just continuously calibrate the math.
CEO Kropelnicki explicitly called this a big deal in the earnings call. And from a corporate finance perspective, he is entirely correct. It smooths out the revenue forecast, prevents these massive uncollected balances from building up, which keeps the company's cash flow vastly more predictable.
Right.
For a retail investor trying to model CWT's earnings over the next 3 years, this SAM mechanism means the stock will be significantly less volatile when it comes to the unpredictable impacts of weather patterns and state conservation mandates.
Okay, that is a phenomenal breakdown of the top line. We have effectively decoded the headline numbers. The 16.6% revenue jump and the 93-cent EPS beat look fantastic on a stock screener. But we now know they are heavily juiced by the IRMA back pay and the deferred RAM recognition.
Exactly.
The true actionable takeaway for the investor isn't the 17% growth. It's the fact that the grueling 2024 California general rate case is finally settled. The new rates are live as of July 1st, and they have this new sales adjustment mechanism locked in to keep their cash flow smooth.
That is the exact correct synthesis. But revenue is only half of the equation, right?
Right.
A company can grow its top line to the moon, but if its operating costs are compounding faster than its revenue, the business will eventually implode. To really arrive at a talk ticker's verdict, we have to flip the income statement over and look at the cost side of the ledger. Because while the revenues in Q2 looked artificially juicy, the rising costs are very, very real.
And the CFO is very transparent about those rising costs. He noted that total water supply costs, so the actual raw expense of purchasing wholesale water, pumping groundwater, and the electricity required to move it, jumped by $6.3 million. He attributed this to higher per unit production costs.
Yeah.
Essentially, the fundamental cost of processing and moving a gallon of water from an aquifer to a residential tap is significantly higher today than it was a year ago. On top of that, their income tax expense rose by $7 million, driven both by higher taxable income and a slightly higher effective tax rate.
Those are standard operational headwinds. I mean, every utility in the country is dealing with inflation in labor, chemicals, and power. But there is a much larger issue lurking in the transcript. There's an absolute elephant in the room, or rather an elephant in the water supply, that every single utility investor needs to understand immediately because it is reshaping the entire industry's capital structure.
You are talking about the PFAS crisis?
I am. PFAS. Per and polyfluoroalkyl substances, colloquially known in the media as forever chemicals.
Let's do a quick plain English primer on this for the listeners who haven't been tracking environmental litigation news. What exactly are PFAS? How did they get into our drinking water? And why are they suddenly blowing massive craters in utility balance sheets?
Well, PFAS are a massive family of thousands of highly complex synthetic chemicals. They were invented back in the 1940s and have been used extensively by massive industrial conglomerates to manufacture consumer products that require resistance to heat, water, and oil.
Like what kind of products?
If you have ever cooked on a nonstick Teflon pan, worn a stain-resistant rain jacket, or seen a firefighter use chemical foam to put out a jet fuel fire, you have interacted with PFAS.
The miracle chemicals of the mid-20th century.
Exactly. But their greatest industrial strength, their nearly unbreakable chemical bonds, is also their greatest environmental flaw. They're incredibly durable. That is why they are called forever chemicals. They do not break down in soil, they do not break down in water, and most alarmingly, they do not break down in the human body. Because they've been used so ubiquitously for 80 years, they have slowly, relentlessly leached off of landfills, out of manufacturing plants, and off of military bases directly into the groundwater aquifers that supply the nation's drinking water.
And the scientific consensus over the last decade has started linking long-term exposure to these forever chemicals to some incredibly severe health outcomes, including various cancers, liver damage, and immune system suppression.
Which brings us to the regulatory reckoning. The EPA recently finalized strict, legally binding new limits on PFAS levels in municipal drinking water. And when I say strict, I mean they are demanding these chemicals be filtered out down to near zero levels parts per trillion.
Just to put that in perspective, a part per trillion is roughly equivalent to 1 drop of water in 20 Olympic-sized swimming pools. It's microscopic.
Right. And the problem is that standard municipal water treatment plants, the facilities built in the 70s and 80s that use basic chlorine and sand filtration, they were never designed to catch synthetic chemicals at a microscopic level.
No, of course not.
To comply with these new federal mandates, water utilities across the entire country are being forced to design, permit, and construct entirely new, highly advanced filtration infrastructure. They have to build massive facilities utilizing granular activated carbon filters, ion exchange resins, or high-pressure reverse osmosis systems.
Which is incredibly capital intensive. And that brings us directly to the numbers CWT reported. CEO Kropelnicki stated on the call that they have modeled out a $155 million net budget specifically for PFAS treatment infrastructure.
$155 million.
And year to date, they have already deployed $30 million of capital into this program. Let's contextualize that for the retail investor. For a company that generated $309 million in total revenue for the quarter, facing a sudden mandatory $155 million capital requirement just to filter out one specific family of chemicals, I mean, that is a staggering financial burden.
It is a massive capital requirement that threatens to upend their balance sheet. But you used a very important word when you read the CEO's quote. You emphasized that it was a $155 million net budget.
And this is where the transcript gets incredibly fascinating and where CWT's management team proves they are playing chess while others are playing checkers. Kropelnicki specifically clarified that the $155 million estimate is net of $60 million in expected recoveries from polluters.
Yep.
Wait, 60 million, I have to pause here. Are we analyzing a regulated water utility or are we analyzing a boutique environmental litigation firm?
It's a fair question because this is one of the most brilliant strategic maneuvers CWT has executed, and it fundamentally alters the risk profile for anyone holding the stock.
Yeah.
Let's look at the baseline scenario for a standard poorly managed utility. If they suddenly have to spend $215 million to build reverse osmosis plants to clean up PFAS, their only option under traditional regulations is to go to the state commission and demand a $215 million rate hike on their local customers.
Which circles right back to the political friction we discussed earlier. If you hit a working-class neighborhood with a massive bill spike to clean up a chemical spill they didn't even cause, the customers revolt, politicians intervene, the state commission might panic and deny the full rate increase, and ultimately, the utility's shareholders end up eating the financial loss.
Exactly. The standard playbook is a lose-lose for the utility and the consumer. But CWT's executive team went on the offensive. They built a robust legal strategy, and they are actively suing the massive multinational chemical manufacturers, the DuPonts and 3Ms of the world, who originally formulated, marketed, and profited from the PFAS compounds and the firefighting foams that contaminated the aquifers.
And they are actually winning.
They are winning. They have already secured roughly $60 million in legal settlements and state grant funding to directly offset the staggering cost of engineering these treatment plants.
Okay, I see the strategic brilliance, but as a retail investor looking at the mechanics of cash flow, I have to push back on the timing here. Corporate litigation against multinational conglomerates takes years, sometimes a decade, of appeals and delay tactics. Meanwhile, the EPA is demanding compliance right now.
Right, the clock is ticking.
Even with $60 million eventually coming in the door, they are still on the hook to front massive amounts of capital to get these plants built today. Doesn't this create a dangerous cash flow gap in the short term?
It absolutely creates a near-term capital requirement. They have to issue debt or equity to fund the initial construction. However, the reason securing these settlements is so vital for long-term shareholder value is twofold.
Okay, what's the first reason?
First, It proves to the state regulator that CWT is doing everything in its power to protect the local ratepayers from bearing the brunt of the cleanup costs. This builds immense political goodwill, making the regulators much more amenable to approving CWT's other rate requests.
That makes sense.
But second, and most importantly for the stock price, it balances the rate base.
Okay, rate base. You just deployed the most important two words in utility investing. We need to transition seamlessly into the core of CWT's financial engine because you literally cannot evaluate a utility stock without mastering the concept of the rate base.
I agree completely. When a retail investor looks at a high-flying tech stock, they obsess over monthly active users, gross margins, customer acquisition costs. But when you are evaluating a regulated utility, rate base is the sun around which the entire financial solar system orbits. It dictates everything.
I want every listener to visualize this clearly without any jargon. What exactly is a rate base?
Think of the rate base as a giant state-audited ledger. It is the total aggregated financial value of all the physical infrastructure the utilities built, paid for, and currently utilizes to deliver water to the public.
So pipes and stuff.
Exactly. It includes every mile of subterranean cast iron pipe, every concrete reservoir, every chemical treatment facility, every industrial pump, and even the fleet of service trucks they drive. When CWT spends $10 million designing and constructing a brand new water tower, and the state regulator officially agrees that the tower was a prudent, necessary investment to serve the public, that $10 million gets officially added to the utility's rate base tally.
Okay, so it's the total approved value of their physical empire. But why does the size of that physical empire matter to me, the stockholder sitting at home analyzing their EPS?
Because of how utilities are legally allowed to generate profit. A utility is legally prohibited from marking up the wholesale cost of the water itself.
Wait, really?
Yeah. If CWT purchases wholesale water from a municipal district for $1 a gallon, they must sell it to the residential customer for exactly $1 a gallon. They pass that cost through with zero markup.
If they can't mark up the product they're selling, where does the actual profit come from? Where does the cash that funds my quarterly dividend originate?
The profit is generated exclusively through a guaranteed return on the rate base. The state regulator looks at the ledger and says, okay, CWT, you have successfully built and currently manage $1 billion worth of approved infrastructure in your rate base. Because you deployed that capital to serve the public, we will legally authorize you to earn a 10% profit on that $1 billion asset base every single year.
Okay.
So in that simplified scenario, their authorized annual profit would be $100 million.
So the underlying math of the utility business model is incredibly simple but profound. If management wants to grow their total net income, they cannot rely on selling more water. The only possible way to grow their total profit is to aggressively grow the total size of the rate base.
You got it.
They are financially incentivized to build more infrastructure. They literally have to spend money to make money.
That is the core dynamic. Utilities are the most capital-intensive businesses on Earth. They exist on a perpetual, never-ending treadmill of tearing up roads to replace century-old pipes, building deeper wells, and engineering complex filtration plants, because that capital expenditure, what Wall Street calls CapEx, is the primary fuel for earnings growth. We refer to this continuous cycle as the CapEx flywheel.
Which brings us to the most stunning piece of forward guidance from the entire earnings call. CWT's management team projects their total rate base will reach a staggering $3.5 billion by the end of 2028.
$3.5 billion.
Let that number sink in. $3.5 billion worth of approved infrastructure generating guaranteed returns. CEO Krepelnicki proudly noted that this trajectory represents a 12% compound annual growth rate, or CAGR, for the rate base.
A 12% annualized growth rate in the underlying physical asset base that generates their guaranteed profit. If you are a retail investor looking for long-term visibility, a state-sanctioned 12% growth engine is just phenomenal.
And the raw CapEx numbers prove they are executing on it. In the second quarter alone, their capital expenditures hit $147 million, which is up 23.1% year over year. Year to date, they have aggressively deployed a record $270 million into infrastructure projects. When you zoom out, their 10-year infrastructure investment CAGR sits at 11.4%. They are an absolute machine at putting capital into the ground.
They are executing flawlessly on the build-out. But there is a critical regulatory nuance here that makes CWT uniquely attractive compared to utility stocks operating in the Midwest or the East Coast.
Right.
We really have to discuss the California advantage.
I flagged this exact dynamic while reading the transcript. Kropelnicki made a very pointed argument about how the regulatory environment in California handles this massive capital spending compared to how their other operating markets, like Washington State, handle it. The key differentiator he emphasized is that in California, this capital is pre-approved prospectively.
And that single word, prospectively, changes the entire risk profile of the stock. Let me contrast it. In what the industry calls a historical test year state, a utility takes on all the initial risk.
Okay.
The utility identifies a failing pipeline. They spend $50 million of their own capital to tear up the street and replace it. And then, a year later, they go to the state commission and say, please audit what we did last year, agree that it was necessary, and allow us to put that $50 million into our rate base so we can finally start earning a return on it.
That sounds incredibly stressful. You are basically floating a $50 million loan to the public and just praying the state bureaucrats eventually agree to pay you back.
Let me try a different analogy for this. It's not like buying a car for a teenager. It's like operating as a defense contractor.
I like where this is going. Operating in a historical test year state is like a defense contractor deciding to build a $1 billion experimental aircraft carrier, using their own corporate funds, floating it out into the ocean, and then inviting the Navy on board to ask, hey, do you guys want to buy this? There's a massive risk the Navy says no, and you are left holding a $1 billion bag.
That is a much more accurate analogy for the scale of capital at risk. But California does not operate that way. California is a prospective regulatory environment. It's like the Navy signing the contract and fully authorizing the budget before the contractor ever lays the keel of the ship.
Much better.
Through the grueling 2024 general rate case process we discussed earlier, the California regulators scrutinized CWT's engineering plans for 2024, 2025, 2026, and 2027, and they officially pre-approved the spending.
They gave them the green light before the shovels hit the dirt.
Exactly. The commission authorized a massive $1.45 billion in capital expenditures for that 4-year cycle. On top of that, they approved an additional $229 million in what are known as advice letter projects, which is essentially a regulatory fast-track approval process for specific predefined infrastructure investments.
So if you add that up, management has nearly $1.7 billion in fully pre-authorized capital spending locked into their forward projections.
Yes. And for you, the retail investor trying to model future earnings, this prospective model makes CWT vastly more predictable. You don't have to bite your nails wondering if their record CapEx is going to be rejected and excluded from the rate base. You already hold the regulator's signed blueprint for the next 3 years.
Right.
Assuming CWT's management team executes operationally, assuming they actually buy the pipes, hire the crews, and build the infrastructure on time, that 12% rate base growth is virtually guaranteed by the state.
And the actual financial returns they are permitted to earn on that rapidly expanding rate base are exceptionally healthy right now. When we analyze a utility, we look at their authorized return on equity, or ROE. The CFO reported that they recently settled a rate case in their smaller Washington state market that secured a 10.12% ROE, which will drive a $4.12 million annualized revenue increase.
Right.
But more importantly, in their massive foundational California market, their authorized ROE sits at a very robust 10.27%.
A 10.27% guaranteed return on billions of dollars of pre-approved infrastructure is an incredibly powerful compounding engine.
But I have to put myself in the shoes of the skeptical retail investor right now. If I look at the macroeconomic environment today, I can log into my brokerage account and buy a 6-month U.S. Treasury bill that yields roughly 5%. That Treasury bill is backed by the full faith and credit of the U.S. government. It is virtually risk-free. Why should I take on the inherent volatility of buying a stock, exposing myself to market corrections and execution risk, just to earn a 10.27% return on equity from a water utility? That 5% spread doesn't seem like enough of a risk premium.
It's a sophisticated question, and it speaks to the core of asset allocation. You are right that the risk-free rate is currently high. But you have to look at the mechanics of equity compounding versus a static bond yield. That 10.27% ROE isn't just a static yield paid out to you. It is the return the company generates internally on its equity base.
Okay, explain that difference.
CWT pays out a portion of that return to you as that 7.6% growing dividend, and they retain the rest to reinvest back into that 12% CapEx flywheel. A Treasury bill pays you 5% today, but it doesn't grow. CWT's rate base is expanding by 12% annually, meaning that 10.27% return is being calculated on a geometrically larger pool of assets every single year. You are buying a compounding growth engine, not a static yield instrument.
That distinction is crucial. You are buying the growth of the underlying asset base. Which naturally brings us to the next critical question about capital allocation. If CWT has this incredible state-approved internal engine generating 12% growth simply by replacing their own aging pipes, what do they do with the excess cash they generate?
Good question.
Do they act like a Silicon Valley tech giant and start aggressively acquiring smaller competitors to artificially juice their top-line numbers?
This leads us directly to the M&A and balance sheet discussion, and it highlights a moment from the Q&A portion of the earnings call that tells you everything you need to know about the discipline of this management team.
This was undeniably my favorite moment of the entire transcript. An equity analyst from a major bank was probing Kropelnicki on their mergers and acquisition strategy, essentially trying to goad the CEO into announcing an aggressive campaign to buy up smaller municipal water districts. And Kropelnicki fired back with an incredibly blunt response.
It was so good.
I want to read the direct quote. "We are not going to go out on a buying spree and buy at multiples of book because we need rate-based growth. We do not need rate-based growth. We have plenty of rate-based growth in our existing book of business."
That specific quote is absolute music to the ears of a disciplined value investor.
As someone who evaluates corporate transcripts for a living, I have to heavily praise that level of restraint. We live in an era defined by corporate empire building. CEOs have massive egos, and they love to orchestrate splashy billion-dollar acquisitions simply to make their total addressable market look bigger on a slide deck.
Right, just to show growth.
They frequently overpay for these acquisitions, buying companies at massive, unjustifiable premiums to their actual book value, which ultimately destroys shareholder value as they struggle to integrate the disparate cultures and systems.
But Kropelnicki is looking at the board and saying, why would I ever risk shareholder capital by overpaying to acquire someone else's neglected, broken water systems when the state of California has already handed me a pre-approved authorization to deploy $1.7 billion into upgrading my own pristine infrastructure at a guaranteed 10.27% return?
It is the ultimate display of capital discipline. Management is leaning entirely on their internal 10% plus replacement capital engine rather than overpaying for risky external growth.
That being said, they are not completely ignoring external growth. They are simply engaging in what I would characterize as highly strategic surgical M&A. They are acquiring assets that fill specific geographic or operational niches.
Right. The CEO did highlight two very specific strategic moves. First, they are currently integrating an acquisition called Nexus, which brings a portfolio of water and wastewater assets across Oregon, Nevada, and Washington. They expect that regulatory integration to fully close by the end of the year. This gives them a broader geographic footprint across fast-growing western states, diversifying them slightly away from purely California regulatory risk.
And the second move is even more interesting from a demographic perspective. They are actively consolidating a joint venture known as BVRT. This is a wastewater partnership located in Texas. CWT just submitted a formal application to buy out the remaining partners and assume 100% sole ownership of the venture.
And Texas is huge.
Yeah, and the underlying business metrics are highly favorable. They noted they just brought 200 brand new wastewater connections online in the South Austin market during the quarter.
Establishing a beachhead in Texas is a massive strategic play. The macroeconomic and demographic trends in Texas are undeniable. The population growth is explosive, corporate relocations are driving housing starts, and yet water remains an incredibly scarce and highly stressed resource in the state. Getting a firm foothold in the Texas wastewater and water management sector, particularly in the booming Austin corridor, provides a massive runway for future capital deployment.
It really does.
But expansion, even surgical expansion, requires significant capital. Let's audit their balance sheet. How is CWT financing $270 million in year-to-date CapEx while simultaneously funding these acquisitions?
CFO Jim Lynch provided a very clear breakdown of their liquidity position. They are utilizing a balanced mix of equity and debt while maintaining a very conservative leverage profile. On the equity side, they successfully raised $88.8 million during the second quarter by utilizing their ATM program.
ATM. That stands for at-the-market offering. We need to explain this mechanic because it is vastly superior to how many struggling companies raise cash. For the retail listeners, usually, when a company needs a massive injection of cash, they execute a secondary stock offering.
Right, a traditional secondary.
They announce they're selling millions of new shares all at once, usually selling them in bulk to large investment banks at a steep discount to the current trading price. It instantly dilutes existing shareholders and usually causes the stock price to gap down aggressively the next morning.
It's a violent, disruptive way to raise capital. An ATM program is the exact opposite. With an at-the-market program, CWT authorizes their broker to quietly, incrementally sell small batches of newly issued shares directly into the open market on a daily basis at the prevailing market price.
So if the stock is trading well on a Tuesday, they might trickle a few thousand shares into the daily trading volume.
Exactly. It allows them to raise that $88.8 million organically over the course of the quarter without triggering a massive dilution event or spooking the market. It is a highly efficient, shareholder-friendly way to fund their equity needs.
So they are smartly managing their equity issuance, and they maintain what looks like a fortress of liquidity. The CFO noted they are sitting on $43.4 million in unrestricted cash on the balance sheet, and they possess $395 million in available untapped liquidity drawn from their $600 million syndicated bank lines of credit. Furthermore, they maintain an A+ stable corporate credit rating from Standard & Poor's.
That credit rating is a vital metric for a utility because they are constantly issuing bonds to fund that $1.7 billion CapEx pipeline. Maintaining an A+ rating ensures that when they do go to the debt markets, they command the lowest possible interest rates, which protects their net income margins.
But as I was reviewing the balance sheet details in the transcript, one specific line item jumped out at me. The CFO mentioned they are holding $45.7 million in restricted cash. That is a highly specific chunk of capital to have locked up. When analysts pressed him on what that restricted cash was earmarked for, he revealed it is dedicated to a potable water pipeline project in partnership with the Guadalupe Blanco River Authority, the GBRA, down in Texas.
And that detail connects perfectly to our earlier discussion about their strategic expansion. This GBRA project will represent CWT's very first foray into operating a potable drinking water system within the state of Texas.
So they aren't just doing wastewater in Austin anymore. They are moving up the value chain into primary drinking water delivery in one of the most demographically explosive states in the country. That is a major long-term operational catalyst.
It is. Okay, so if we synthesize the deep dive so far, the top line numbers are robust. The regulatory environment in California is currently highly favorable with prospective CapEx approval. The 12% internal compounding flywheel is humming, and the balance sheet is fortified with A+ credit and efficient equity mechanisms.
I mean, it sounds like a flawless investment.
But we know no stock operates in a vacuum, and no equity is without existential risks. To provide a truly objective talk ticker's verdict, we have to pivot and analyze the macro threats. What are the specific systemic forces that could derail this 100-year-old compounding machine?
The most immediate risk is political, and it centers entirely around the growing debate over utility affordability. Now, before we dive into this, I want to be explicitly clear with the audience. We are maintaining strict political impartiality here.
Of course.
We are not endorsing, validating, or condemning any specific political viewpoints or organizations. We are strictly analyzing the geopolitical landscape as a business risk factor, exactly as management presented it on the call.
Understood.
Yeah.
How did the affordability issues surface on the call?
An analyst from Baird directly challenged the CEO regarding the escalating national rhetoric surrounding utility bills. There is massive growing pushback from consumers across the country regarding the relentless pace of utility rate increases.
It's everywhere.
CEO Kropelnicki did not dodge the question. He openly acknowledged the political pressure. He specifically cited that organizations like the Democratic Socialists of America have officially made utility rate affordability and consumer protection a major plank in their political agenda. There is a concerted, organized political push in various jurisdictions to aggressively cap, lower, or heavily subsidize utility bills because of the severe financial strain it places on working-class consumers.
From a purely analytical standpoint, it is a highly valid risk factor. If a state utility commission succumbs to populist political pressure and outright refuses to allow a utility to raise rates to cover their legitimate inflationary costs and infrastructure investments, the utility's profit margins collapse, and the shareholder ultimately eats the financial loss. The political environment directly dictates the financial environment.
But the CEO laid out a very data-driven, multi-pronged defense for why CWT is currently insulated from this political crossfire. He detailed two primary defenses regarding affordability. First, he pointed to the EPA's internal affordability test.
The 2% rule.
Right. The Environmental Protection Agency generally considers municipal water bills to be affordable if the total annual cost remains below 2% of the average household's total budget. Kropelnicki stated on the record that CWT's rates remain safely below that 2% threshold across all of their operating districts.
And second, he highlighted their proactive use of social safety nets. CWT actively leverages tools provided by the state of California, such as specific rate support funds and low-income rate assistance programs, to directly subsidize the monthly bills for their most vulnerable consumer populations.
Right, getting ahead of the issue.
By aggressively utilizing state funds to protect low-income households, CWT actively diffuses the most potent political arguments against their rate-based growth.
He also made a fascinating broader argument about the nature of the utility crisis itself. He argued that water bills are not the catalyst driving the consumer affordability crisis. Electricity bills are. He noted that California currently suffers from the second highest electric rate increases in the entire United States. Those massive electric rate hikes are being driven by the need to harden the electrical grid against catastrophic wildfires, settle massive legal liabilities, and build out immense new power generation capacity to feed the explosion of AI data centers.
That is a crucial distinction for the investor to internalize. When a consumer opens their mail and sees a $400 monthly power bill, they are furious. When they see a $40 water bill, it barely registers. Water utilities are occasionally getting caught in the generalized political crossfire directed at the utility sector as a whole, but they are not the root cause of the consumer outrage. Regulators intimately understand that subterranean water infrastructure is crumbling and desperately requires capital investment, and so far they have shown zero inclination to block CWT from making those critical pre-approved investments.
But localized political affordability isn't the only external threat. We also have to address the global macroeconomic environment. And this is where the Q2 earnings call took an incredibly unexpected turn.
Oh, this was wild.
The CEO went on a massive, highly academic deep dive into macroeconomics. It was an absolute geek-out moment for anyone who follows monetary policy. He suddenly started citing John Maynard Keynes, analyzing the impacts of global deficit spending, and name-dropping Federal Reserve Chair Jerome Powell.
It is exceptionally rare to hear a regional water utility CEO lecturing analysts on Keynesian economic theory during a quarterly update.
It was wild, but we need to translate what he was actually concerned about beneath the academic theory. He expressed deep concern over ongoing global economic instability. Specifically, he argued that massive, sustained government deficit spending, partially tied to global geopolitical conflicts and elevated military spending, acts as a continuous underlying economic stimulus. His fear is that this relentless government spending will keep inflation uncomfortably sticky for years to come.
And if inflation remains sticky, defying expectations of a cool down, the Federal Reserve, led by Jerome Powell, simply cannot lower interest rates. Or in a worst-case scenario, they may be forced to hike rates even further to crush that resilient inflation.
Okay, let's connect the dots for the listener. Why does a guy running a water company in California care so deeply about Jerome Powell, sticky inflation, and the Federal Reserve's target interest rate?
Because, as we established earlier, utilities are the ultimate debt junkies. Remember that massive $1.7 billion CapEx flywheel. They are spending billions of dollars on pipes and filtration plants. They do not fund all that construction with cash on hand or equity issuance. They issue massive amounts of corporate bonds into the financial markets to pay for it.
So if the Federal Reserve keeps interest rates elevated, the yield that CWT has to offer to convince investors to buy their newly issued corporate bonds goes up significantly.
Precisely. If borrowing costs spike, their total corporate interest expense skyrockets. That massive interest burden goes straight to the bottom line, directly eating into their net income, crushing their EPS, and threatening the safety of that 326-quarter dividend streak.
So in a standard financial model, a sustained high interest rate macroeconomic environment is a nightmare scenario for utility stocks. The surging cost of debt crushes their operating margins, and simultaneously, their dividend yields look significantly less attractive to retail investors when compared to the high yields offered by risk-free government bonds. High rates should theoretically decimate CWT.
In a standard financial model, yes, that is exactly how it plays out. But as we have seen repeatedly today, CWT is not operating in a standard model. They are operating in the highly structured regulatory environment of California. Which brings us to the ultimate competitive moat, the specific regulatory superpower that CWT possesses to combat macroeconomic inflation.
This is the linchpin of the bullish thesis. Walk us through it.
It is a regulatory provision formerly known as the cost of capital adjustment mechanism.
We need to explain exactly how this mechanism functions because it completely rewrites the risk profile we just discussed.
The California Public Utilities Commission inherently recognizes that while a utility can control its internal operating costs, it has zero control over global macroeconomic interest rates dictated by the Federal Reserve. So, to ensure the utilities remain financially viable enough to maintain the state's water infrastructure, the Commission created a structural safety valve. The cost of capital adjustment mechanism constantly tracks Moody's AA utility bond index,
which is essentially the benchmark index representing the average cost of borrowing money for high-grade blue-chip utility companies.
Correct. The state monitors that index. If that benchmark index swings up or down by more than 50 basis points from the baseline rate established in CWT's last general rate case.
Wait, let's define 50 basis points for clarity. That means a movement of exactly 0.5%, correct?
Yes, 0.5%. If the global cost of borrowing jumps by more than 0.5%, CWT does not have to suffer in silence and wait 3 years for their next general rate case to beg for financial relief. This mechanism allows them to automatically file an application with the state to aggressively adjust their authorized return on equity upward to mathematically compensate for the higher cost of debt they are forced to pay.
Let me make sure I am fully comprehending the magnitude of this. If inflation spikes out of control and Jerome Powell hikes interest rates to 8% and corporate borrowing becomes incredibly expensive, CWT can essentially bypass the pain and just pass that higher macroeconomic cost directly back to the California ratepayer by legally adjusting their allowed profit margin upward.
That is exactly how it functions. It is a symmetrical two-way mechanism. If global interest rates plummet, the ROE gets adjusted downward, which protects the ratepayer from overpaying. But in a rising or sticky rate environment, it forms an impenetrable shield for the shareholder. In fact, as CEO Kropelnicki noted on the call, this exact mechanism actually triggered upward during the last inflationary cycle. That automatic upward trigger is a major reason why CWT currently enjoys one of the highest authorized ROEs in the entire country at that 10.27% figure.
So what is the definitive talk ticker's takeaway on this macro risk? This cost of capital adjustment mechanism effectively immunizes CWT against sudden, severe interest rate spikes. It completely neutralizes the biggest, most existential macroeconomic threat to a utility's long-term earnings model. It transforms them from a standard dividend play into a uniquely fortified safe harbor asset.
It is a tremendous structural advantage, a massive competitive moat that the vast majority of retail investors completely overlook when they are just casually glancing at a trailing PE ratio on a stock screener.
Which perfectly sets the stage for our final synthesis. We have ripped this transcript apart. We have covered the headline numbers and exposed the regulatory catch-ups. We have busted the jargon around IRMA's Rams and Sams. We have analyzed the brilliance of the $155 million PFAS litigation strategy. We have marveled at the $1.7 billion pre-approved CapEx flywheel. And we have mapped out their impenetrable moats against macroeconomic risks. It is time to bring all of this data together for the final talk ticker's verdict.
But before we deliver that final verdict, I want to touch on one specific operational detail the CEO highlighted near the end of the call, because it speaks volumes about the internal culture and the execution capacity of the company.
You are referring to the 100-year anniversary celebration and the promotion of Tammy Johnson.
Yes. CWT is officially celebrating 100 years of continuous service. The company was founded back in the 1920s by 3 veterans returning from World War I. That kind of corporate longevity, surviving a century of economic upheavals, is exceedingly rare in the modern market. But the specific promotion of Tammy Johnson to Vice President of Operations for California is what truly caught my analytical attention.
The CEO dedicated a significant portion of his closing remarks to her background. Tammy Johnson did not parachute into the C-suite from an Ivy League MBA program or a stint at a massive management consulting firm. She started at CWT 40 years ago as a union field worker, turning wrenches in the Bakersfield heat. She spent decades working her way up through the operational and union ranks. She went back to school for her advanced degrees later in her career. And most critically, she currently holds a DeFi operating license, which Kropelnicki noted is the absolute highest, most stringent level of water operating license you can legally hold in the state of California.
And why does that specific resume matter to a retail investor trying to model future cash flows?
Because utilities are not software companies. They are, at their absolute core, incredibly heavy, dangerous operational businesses. They are responsible for continuously moving millions of gallons of heavy, pressurized, chemically treated liquid through aging pipes buried under densely populated city streets. Infrastructure inevitably fails. Pipes burst. Crises happen. And when a massive main breaks at 2 a.m. and floods a downtown intersection, you want an executive who intimately knows how to manage a repair crew, deploy heavy machinery, and navigate the crisis, not just a spreadsheet jockey whose only skill is financial engineering. Deep, calloused operational DNA in the executive suite is exactly what retail investors should demand in utility leadership. It drastically minimizes the execution risk on that massive, multi-year $1.7 billion capital deployment plan.
I fully agree. The operational leadership matches the financial discipline. So with all the data on the table, it is time for the Talk Ticker's final verdict.
Based on the Q2 2026 transcript, are we bullish or bearish on California Water Service Group?
Based on the underlying data, the highly favorable prospective regulatory environment in California, the impenetrable macroeconomic moats, and the proven execution of the management team, my analytical stance is highly bullish. However, I must caveat that it is specifically bullish for a certain demographic: income-oriented, long-term, risk-averse investors.
I am arriving at the exact same conclusion. I am slapping a massive bullish label on CWT for the core portfolio. Let's synthesize exactly why for the listener, breaking it down into the 4 core pillars of our thesis. Number 1 is unassailable visibility. The grueling 2024 California general rate case is finally settled and in the rearview mirror, effectively locking in nearly $1.7 billion in pre-approved prospective capital investments. We know exactly what they are allowed to build.
Number 2 is predictable, compounding growth. Their asset rate base is mathematically projected by the state to grow at a 12% compound annual growth rate through the end of 2028. That internal CapEx flywheel is spinning flawlessly, supported by a disciplined management team that flatly refuses to dilute shareholder returns with overpriced, ego-driven M&A.
Number 3 is income reliability. The dividend growth is remarkably steady at a 7.6% CAGR, backed by a staggering 326-quarter track record of uninterrupted payouts.
And number 4 is the existence of impenetrable structural moats. They possess specialized regulatory protections against the 2 most existential threats to the utility sector. The newly implemented sales adjustment mechanism protects their revenue against unpredictable volume fluctuations driven by extreme weather or state conservation mandates. And the cost of capital adjustment mechanism effectively immunizes their profit margins against macroeconomic inflation and sudden Federal Reserve interest rate spikes. Furthermore, they're aggressively utilizing offensive litigation to offset the massive capital burdens of PFAS environmental compliance, shielding both the ratepayer and the shareholder.
So, here is the final actionable advice for you, the retail investor tuning in. If you are a 25-year-old momentum trader looking for a volatile tech stock that is going to double in the next 3 weeks based on an AI press release, CWT is absolutely not for you. You will be bored to tears. But if you are actively building a robust long-term portfolio, if you prioritize compounding income, and if you want an anchor asset that can comfortably weather a severe economic recession or an unexpected inflation spike, CWT is the ultimate sleep well at night holding. Buy the stock, enroll in the DRP program to automatically reinvest those dividends, and let that 12% state-mandated rate-based growth compound your wealth over the next decade.
It is the absolute epitome of a get-rich-slowly equity.
Well summarized. We have successfully ripped this transcript apart, translated the Wall Street jargon into actionable intelligence, and delivered the Talk Ticker's verdict. But before we sign off, I want to leave you, the listener, with one final, broader macro concept to ponder something that extends far beyond the Q2 numbers of this specific company.
What broader thesis are you looking at?
Look at the trajectory of global environmental mandates. As climate change forces increasingly massive and expensive infrastructure overhauls across the entire country, whether it's the EPA mandating the filtration of forever chemicals like PFAS, coastal cities being forced to build multi-billion-dollar seawalls, or electric utilities being forced to harden their entire grids against catastrophic wildfires, the utility sector is going to be forced to spend trillions of dollars over the next 3 decades.
They are entirely on the front lines of global climate adaptation. They have to build the physical defenses.
Exactly. And my question is this: Will California's unique regulatory model of pre-approving massive utility capital expenditures prospectively become the required blueprint for the rest of the nation? Because if it does, if public utility commissions nationwide suddenly realize they have no choice but to guarantee robust returns in order to incentivize this critical society-saving climate spending, then regulated utilities like CWT are no longer just boring, sleepy dividend plays.
If that regulatory shift happens nationally, they quietly transform into the ultimate government-backed climate adaptation growth stocks. They become the primary beneficiaries of a multi-trillion-dollar infrastructure supercycle.
And that is a macroeconomic thesis worth diving into on your own time. Thank you for joining us for this deep dive. Keep looking past the headline numbers, keep demanding plain English from corporate executives, and we will catch you on the next Talk Tickers Breakdown.